I've heard it said that Uncle Sam has a tall hat so that he can collect more as he holds it out. I know that's a bad joke. I'm a dad. I tell dad jokes, so that's how it goes. But uh, when it comes to retirement income, I know a lot of my clients, a lot of folks I speak with, really loathe having to pay taxes. Oh, and of course, everybody is okay paying their fair share, but nobody wants to pay more than they have to. And so there are very legal ways, very strategic ways where Disney employees can retire with tax-free income. So, if you are interested in having tax-free income or at least reducing your tax bill in retirement, here are three strategies to consider when it comes to your financial plans. The first is using the idea of what's called a Roth conversion. And so, Roth conversion is basically taking the amount of money that's in a traditional IRA or 401k and moving some or all of that into a Roth 401k or Roth IRA. And whenever you do that, you're forced to pay taxes on it at that time. So you want to understand what your taxes are in this year. But however, once you do that Roth conversion, then you no longer have to pay taxes on that money moving forward into the future. And so you're able to have income that you can pull from your account tax free through the Roth. So you can do that through converting money from traditional to Roth, or even just contributing to Roth. And making the decision to stop contributing to a traditional account or limit your contributions to a traditional account and start contributing to a Roth account. So that's the first one. The second one is using health savings accounts and using them health savings accounts strategically. So the Walt Disney Company does offer a health savings account, and that's through a high deductible insurance plan. The Disney vernacular, at least as of 2024, was a consumer choice plan. And what that in essence means is you are going to pay a lower health insurance premium, but you have a higher deductible associated with your health insurance. And so this isn't for everybody. You want to make sure you understand and run the numbers of your health situation and how much insurance coverage you need and all of that. But if you're in decent health and you don't really go to a doctor a lot, other than maybe just kind of regular medical visits and all of that, this maybe is an option for you. And so in essence, what you're doing is you're contributing to this health savings account. A health savings account is the only account that's tax free three ways. So the money that you put into it, you get a tax deduction on it. You can put up to it's around $7,000, $8,000 for a couple, around $3,500 for an individual. The money that you put into it, so let's say you put in $5,000 into a health savings account, you that reduces your taxable income by $5,000 a year that you make the contribution. You also can invest the money in a health savings account. The Disney plan, you have to invest more than once you have more than $2,000 in there, then you can have access to the health savings account to be able to invest. And you may or may not want to do that amount. You may want to put some more cash aside for if there is some sort of medical emergency or something of that nature where you have to pay for those costs. However, you can invest that money, and if the investments do have earnings, if they have earnings, of course, investing there's no guarantees, but if the investments do have earnings over time, the earnings also are tax free, and then whenever you take the money out, you also, as long as it's for appropriate healthcare costs, which Medicare insurance premiums is included in that. Cobra insurance premiums is also included in that, and a litany of other things that you can look on the IRS website for. But in essence, if you pull the money out for a covered medical expense, the money is tax free. And we know at least in Medicare costs, you're looking at $170 per person in a couple, so $170 plus per person for a couple. So that's a little over $300 a month that you're going to have those expenses. So if you have money saved in a health savings account to cover those health insurance expenses, that's going to be able to pay for those without having to do any sort of tax ramifications. The third thing is if you are able to save or have saved outside of your 401k, you have additional savings, whether you bought the company stock over the years, or you have savings that you've saved into a brokerage account, you've bought mutual funds or what have you. There are investment vehicles that provide tax-free interest called municipal bonds. A municipal bond is basically a bond issued by a local city or state government, and they're not federally taxed. And if you're in Florida, we have no state income tax. You don't have to worry about state income tax. But if you're in another state that does have income tax, if you buy bonds that are issued by your own state, you also do not have to pay income tax on those. And there's some caveats, of course, with that. So you want to make sure you do your due diligence. But in general, a municipal bond pays tax-free interest. Isn't that awesome? So you can earn interest and not have to pay a penny in taxes on it. And that's really one of the strategies of the ultra wealthy, is to use municipal bonds to provide interest income. So they buy, they invest 1,000 or 10,000 or 100,000 or $1 million into municipal bonds, and they're able to get interest off of that to live without having to pay any taxes on it. So those are just three ways of being able to create tax-free income, and there's lots more strategies as well. But those are just the three that came to mind when it comes to Disney employees looking at retiring with tax-free income. Those are just some tips, and I hope you found value in that. If you have questions or what have you, feel free to drop a comment, like the page, subscribe, and I hope you found value in that. And I hope you have a great day. Take good care. Bye bye.